We wanted to have the wrap up for the conference. We have until 1 o'clock in the room. Ed, Joan, and I would just like to offer some concluding thoughts, and then we'll open up to the extent we can for discussion. On behalf of all three of us, let me just say thank you to all of you for coming, participating, sharing your expertise. It's been a fantastic conference. I always find this to be a really unusual conference. I mean, I go to academic conferences where they're just papers given by really smart people, and if they're in housing, they often don't actually know anything about housing, but they're really good papers, just from a perspective of seeing how one can model things or do empirical work, but there's just a tremendous amount of on-the-ground knowledge that's missing. On the other hand, you can go to practitioner conferences, and the depth of research just isn't there either. So I really love this conference because it really brings both sides together, along with a diverse set of participants that take us all out of our silos, and I think provide the complementary sources of knowledge that it can actually not only produce interesting discussion, but ultimately solutions down the road. And that's what this is really all about. This isn't a discussion society. We're really trying to build a coalition here to change the situation on the ground. Couple other points, and then I'll hand the mic over to Ed. Ed mentioned at the beginning of the conference that we started the International Center on Housing Risk here at AEI at the end of last year, and the whole point of that center is in the title, risk. That's what's unique about the center. Our products that we put out already and are planning to put out are really intended to monitor risk, to provide new information to the market, and ultimately provide the basis for taking action to ameliorate that risk. And it probably wasn't evident that there was so much overlap between this conference and the center in terms of actually who's here. So by my count, 11 of the presenters are members of the center. 2 of the presenters are on our academic council, Susan Wachter and Joe Tracy, and several other members of the center were here as participants in the audience. So we're viewing the center going forward as really being an umbrella organization that can take a lot of this discussion and these activities and try to bring it forward to affect change and not just to monitor the situation, even though that's very important. Third point, it's clear from a lot of academic research that has been done that financial crises really result almost everywhere from excess leverage. And there are really 2 primary sources historically of excess leverage: too much sovereign debt or real estate related credit that wasn't justified given the fundamentals. And since World War II, it's been really heavily on the real estate side, housing, too much mortgage debt. And so that really focuses on the importance of not only better monitoring of housing-related risk, which I know is going on now, and that's good, more resilience in the system through, for example, more capital from financial institutions. That's, I think, on the whole, very good. But I think it also suggests that maybe an alternative, or even complementary to that, would be to take risk out of the system. The system continues to be too risky, and as well as we can monitor the risk and provide resilience in institutions, there's still going to be crises going forward, and really the way to provide greater insurance against that is just to take risk out of the system relative to what we have now. So let me get to my final point, which is really I completely agree with Penny's point of view that she expressed in the last session, that the status quo is unacceptable. I mean, I think all of us on the podium here completely agree that we need to be activists. That might be a strange word for a team here at AEI, but that's really, that's really how we view ourselves. And there are political impediments. Joan mentioned them with respect to the issue about getting the GSEs to change. And so our approach really is not to try to take on strong political interests that we probably can't beat, but just to go around them, to find market-based solutions that reflect a coalition of groups like are represented here that have a common interest in making this system more efficient and less risky, and putting forward those solutions. One of them is this wealth building home loan that Ed and I have been working on and that we're really very excited about. It's not the only thing that can be done, but I think it fits the bill for what we're talking about. And so with that, I'm going to turn the mic over to Ed.
Thank you, Steve, and let me just echo the thank you for all of the presenters, the attendees, everyone who helped make this, I think, a successful conference, and your support and presence here is much appreciated. I think one of the things I talked about yesterday was that bibliography, and I just want to reiterate the people, and they were all men, so back appraisals are pretty much still all men for the most part, probably 80 or 90% men. But back then it was all men, and those 5 men that set up FHA had 5, 10, 15, 20 years experience studying the real estate market. And they really knew what the intrinsics were and what the fundamentals were. And when Alan mentioned this bimodal situation where you're either a renter or an owner. So we didn't reproduce this one. This is the edition right before the one you got yesterday. And it says right on the beginning here, the easiest way for you to pay for a home is to pay for it as you rent. The logical way is to pay monthly out of income, an installment on the principal and interest, etc., and thus, over a given period of years, pay off the entire mortgage and have the house free and clear of all debt. It's very much like buying a house and renting it to yourself. So I think the solution is to bridge what appears to be a bimodal situation. Well, you either buy or rent, but the wealth building home loan is actually designed to be both. You buy, and particularly for low income individuals, you buy the house that you can actually afford based on what you've been paying in rent. And that's how you set your sights on the size and type of house. And then you do that and you self-insure yourself, as you did with FHA, with this broad, straight highway to debt-free home ownership. You do that through much more rapid appreciation, although still a long-term mortgage, 15 years, but much more rapid appreciation than a 30-year loan. So in my mind, the wealth building home loan brings a unifies those two things and sort of squares the circle. It also not only does it for the home buyer, but it does it for the lender. I think it makes the lender's job very different. The lender is now looking at the life cycle of the customer. They're actually looking out for the interest of the customer and helping the customer build wealth, which I think is what financial institutions are supposed to be doing. That's their one of their 2 main functions. Their other main function is to earn a return for their shareholders. Well, putting loans on your balance sheet that are solid loans that have a market return, that have low volatility, are a way to also return profits and dividends to your shareholders. And then if you do have a secondary market, the investor also is protected because the investor has a much less volatile instrument, both from a credit perspective and an interest rate perspective. And so, as Steve said, we need to remove risk and volatility from the system, and we think the wealth building home loan does that in many, many, many different ways. Secondly, we think that given this is our 3rd conference, it's now time, as I said, we've now decided we're not in Kansas anymore, that something has changed. We need to figure out how do we get to the right spot. And so we're going to start communicating with people to set up working groups to try to tackle some of these discrete but large issues. One of them, and I was talking to Joe Tracy earlier, one of them is this issue of second mortgages. It is the way it gets done for borrowers and the first mortgage holder can be a real problem, has been a real problem, and it was a real problem in the 1920s. It was a real problem in the early 1930s, and it was FHA viewed it as a plague on their vision of this integrated approach. And so they restricted seconds as much as they could for decades and decades and decades. And so we think that it's important to get some best and brightest thinkers on this topic to figure out how you solve this problem. As we talk to people to discuss the wealth building home loan, I can name 6 people, all 6 of them after the first 5 or 10 minutes talking about it, then came to, what are you going to do about second mortgages? I mean, that has been a common refrain from 6 people. And so those people have agreed to sort of work with us intellectually to bring that intellectual firepower to how do we come up with a solution for this that works for everyone, protects the consumer, protects the investor, and allows things to move forward, but does provide that protection. So we're going to be doing that over the next weeks and months. As you saw, we got a lot done since the last conference, and we hope to have, by the next conference, next July or whenever, to have another large amount of progress in terms of where we're going here. I'd like to just finish up my part by saying suggestions for this conference improvements that we could make. We are talking about moving it back to the end of July. The hotel situation ended up being horrible. The price of the hotels, the availability of hotels. This was the week of conferences for mortgage conferences, and there's a million other conferences going on. And so July seems to be the time when you don't run into all of that, and the prices are a lot lower. We've traditionally done a 1.5-day conference. Is that the right amount of time? The panels that we have, the coverage, the length of the panels, anything else, I'd open it up to any suggestions. On this conference, or if you want to just send us an email if you don't want to say them publicly. But anybody, any suggestions, comments for this conference or future? Anyone? Everybody's happy? Summer's still chewing. Excuse me? Okay, well, good. But again, feel free to send an email. And with that, I will turn it over to Joan.
Well, I concur. This has been a fabulous conference, and the amount of brain cells in this room are, it's just astounding to me. I had proposed and got, not very far with trying to establish something called the Collateral Risk Foundation, which would be an independent entity comprised of all the stakeholders to the mortgage finance, housing finance world. If you look at who the stakeholders were and that participated in the mortgage meltdown, you have Wall Street, you have Fannie and Freddie, you have VA and FHA, you have regulators, you have realtors, you have appraisers, you have the Mortgage Bankers Association, ABA, NAHB. Each one of those constituents played a role and contributed in their own special way to the mortgage housing finance collapse. So they need to be part of the solution since they were part of the problem. They, of course, each have their own self-interests, so you have to have a pretty strong political will to actually fix the problem. So if there is anybody in the room who actually finds that idea intriguing, please let me know. But I know appraisers play, many think, a bit role in the process, and again, I would respectfully submit that it is appraisers who put the V in LTV. So without that in the equation, we're really massaging numbers that, garbage in, garbage out, and I'm not a statistician, but that's something that I can understand. I think that concludes.
Okay, any other last comments, questions, thoughts, anyone, now that you've had a chance to finish chewing? Going once, going up, yes. Oh,
Thank you.
thank you, thank